It's midnight, the start of a new week, and something just snapped in the global financial system. While you were sleeping, a hidden tripwire was triggered. A secret sell limit just went off across major exchanges, and what you're about to see when the market opens is not the full story. If you're holding silver or gold and you think you can just hit that sell button when the bell rings, you might be in for a rude awakening. The liquidity is drying up from Shanghai all the way to New York. The charts you're looking at, they're showing you a gap down, sure, but the real gap, the one that affects your actual selling price, is much, much deeper. This isn't just about numbers on a screen, it's about the real cash you can get for your assets. I've got my hands on some information that suggests what your broker is telling you and what's happening behind the scenes are two very different things. So, what is this hidden price gap? Let's break it down. When a market opens significantly lower than its previous close, that's a gap down. Usually this happens because of some major news overnight, but what we're talking about here is different. This isn't just about the opening price. It's about the bid-ask spread, blowing out to insane levels. Think of the bid-ask spread as the difference between the highest price a buyer is willing to pay for an asset and the lowest price a seller is willing to accept. In a healthy liquid market, this spread is tiny, but when panic hits and liquidity vanishes, that spread can become a chasm. So while the screen might show gold at, say, $2,300, the highest bid, the best price you can actually sell for, might be $2,250 or even lower. That $50 difference is the hidden gap. It's your money, vanishing into thin air before you even get a chance to react. Now, why is this happening specifically at midnight? Because that's when the Asian markets kick off the global trading week. The first few hours are often the most volatile and have the thinnest liquidity. This is the perfect environment for institutional players to execute large orders that can trigger these massive spreads. They know most retail investors in the West are asleep. They exploit this window of low liquidity to their advantage, leaving everyone else to wake up to a market that's already moved against them and moved in a way the charts don't fully capture. Let's look at the data. I've been tracking off-exchange and dark pool transactions, the trades that happen away from the public eye. And the numbers are alarming. We're seeing massive sell orders for precious metals being filled at prices significantly below the last traded price on the public exchanges. These are not small trades. We're talking about volumes that can, and do, set the tone for the entire trading day. When the New York market opens, it's not starting from a clean slate. It's reacting to this pre-market low liquidity chaos. So what does your broker tell you? They'll probably say it's just market volatility. They might show you the official opening price and say, that's where the market opened. But they won't tell you about the catastrophic bid-ask spread that existed in the first few minutes, where anyone who had a stop-loss order got filled at a terrible price. A stop-loss is meant to protect you, but in this scenario, it guarantees you sell at the worst possible moment, right into the jaws of that hidden gap. Your protection becomes your downfall. This isn't a new phenomenon, but the scale is increasing. With global debt spiraling and central banks in a corner, the financial system is more fragile than ever. Precious metals like gold and silver are seen as safe havens, but that also makes them targets. When there's a rush for the exit doors get very, very small. The big players want to get out first, and they don't mind trampling everyone else to do it. Let's put this in practical terms. Imagine you own 100 ounces of silver. The market closes on Friday with silver at $30 an ounce. Your position is worth $3,000. You wake up Monday, see the price gap down to $29, and you think, okay, I lost $100, I can handle that. But when you go to sell, the best bid available is $27.50. Suddenly, your real loss isn't $100, it's $250. That's the hidden gap in action. Now multiply that by millions of investors around the world. We're talking about billions of dollars in wealth being wiped out, not by the price drop itself, but by the collapse in liquidity. So why isn't the mainstream media all over this? It's simple, it's complex, it's messy, and it doesn't fit into a neat headline. It's easier to report the official opening and closing prices, explaining the microstructure of the market, the bid-ask spreads, the dark pools. That's too much for a 30-second news spot. They report the what, but not the how or the why. And frankly, the big financial institutions who benefit from this opacity have a lot of influence. They prefer you don't look too closely at how the sausage is made. So how do you protect yourself from this midnight disaster? First, knowledge is power. Understanding that this hidden gap exists is the first and most crucial step. Don't blindly trust the numbers on your screen, especially during market opens after a weekend or a major holiday. Second, reconsider your use of market orders and stop-loss orders, especially overnight. A market order says sell at any price, which is exactly what you don't want in a low liquidity environment. You could get filled at a disastrously low price. A stop-loss order can also be triggered by a momentary vicious price spike downwards. Instead, consider using limit orders. A sell limit order ensures you only sell at a price you specify or better. It gives you control, even in a chaotic market. Third, look at how you own your metals. If you're trading paper contracts like ETFs or futures, you are most exposed to this kind of market manipulation and liquidity crisis. These are financial instruments that are easy to trade, but they are also part of the system that allows for this kind of gap. Physical ownership is a different story. If you hold physical gold and silver in your possession, you are insulated from the moment-to-moment volatility and liquidity games of the paper markets. You can decide when and to whom you want to sell, based on your own terms, not the frantic panic of an electronic exchange at midnight. Think about it. The entire point of owning gold and silver for many is to be outside the conventional financial system. So why would you hold it within a digital framework that is susceptible to the system's worst vulnerabilities? The midnight gap is a symptom of a much larger problem: the disconnect between the paper price and the real physical value of these assets. The events unfolding right now are a serious warning. This isn't just a one-off event. It's a dress rehearsal. As financial stress increases globally, these liquidity vacuums will become more frequent and more severe. The gap between what you think your assets are worth and what you can actually sell them for will continue to widen. This is the reality of the market we are in today. It's time to wake up and see what is really happening while the rest of the world is asleep. Don't wait for the mainstream media to tell you what happened yesterday. Understand the mechanics of what's happening right now under the surface. Protect your wealth by being smarter than the average investor. Question what your broker tells you, be strategic with your orders, and seriously consider the merits of physical ownership. The storm is here, and the midnight gap is just the first crack of thunder. Be prepared. Thanks for watching. If you found this information valuable, make sure to like, subscribe, and hit that notification bell so you don't miss our next deep dive into the hidden truths of the financial markets. Stay safe out there.